year is ended and you still feel like you were in the same place you were before you started your grinding arch. But now you're in your 20s, your parents are getting older, fewer friends, career stress, and self-doubt. How long are you going to be seduced by this sirens of YouTube and the false promises of instant gratification? Most aren't even going to watch this because of the mere fact that it's about an hour long and they have the attention span of a goldfish unless I put a Minecraft or Subway Surfers parkour video at the back. Or it's not some fancy indicators hoping to unlock the secrets of the market, but in truth, you are merely trading one illusion for another. If you still believe that, I buy their systems anyway, and I can tell you this, some are not as advertised and some should be getting lawsuits. The market is a stern mistress, and she rewards only those who are willing to put in the work. And what do I see? A sea of faces, mesmerized by the flashy marketing of self-proclaimed gurus who care little for your financial well-being, but only for their own gain. They peddle their wares, promising you the world, but delivering nothing but empty promises and hollow victories. But I am not one of them. I am the antithesis of the charlatans who populate the trading world. I am the voice of reason in a world gone mad. I am the trader who has walked the path, who has felt the sting of loss and the warmth of profit. And I tell you now, I will teach you the true path to profitability, not for a premium, not for personal gain, but because I believe in you. I believe that there are those out there who are willing to put in the work, who are willing to learn, and who are willing to succeed. I will share with you the secrets that I have learned, the strategies that have worked for me, and the mindset that has allowed me to thrive in this cruel and unforgiving market. I will hold your hand, not for a fee, but because I believe that together we can achieve greatness. However, my friends, I ask you, are you ready to join me on this journey? Are you ready to leave behind the false promises and the empty illusions? Are you ready to take the first step towards true profitability? Then let us begin. Let us embark on this journey together, and let us show the world what we are truly capable of. This course is perfect for beginners and experienced traders aiming to master consistency on ICT and volatile markets. Whether you're scalping, day trading or swing trading, it will help you unlock the secrets and strategies of trading with the banks with my proven techniques. Learn how to read market patterns, manage risk, and execute trades with discipline and precision. So here is where ICT come in. ICT trading focuses on understanding the behavior of big players like banks and institutions in the financial markets. It's about reading the smart money moves and following their lead to make profitable trades. And ICT traders try to follow their lead. It's a way of trading that's all about understanding market structure, price action, and the psychology of the big players. Let's begin, shall we? Welcome to episode 1 of the series. I'm to be diving into the basic 3 PD arrays that I use. This will just be a very beginner-friendly video. I'm going to dive into order blocks, fair value gaps, and breakers. And we'll also be talking about sell-side liquidity and buy-side liquidity, or as I have noted, sell stops and buy stops here. I'm not going to be talking about the model in this video, but you need to understand the basics and the fundamentals behind these 3 PD arrays before you can understand the model that I'm going to teach later in this series. So the first PD array that we're going to be covering is the fair value gap. If you already know fair value gaps, breakers and order blocks, you don't really have to watch this part, but I still think it is important to understand these and really understand them like the back of your hand, because if you don't, you're not going to be able to recognize the model as easily. So this is what a bullish fair value gap is. It's essentially a buy side and balanced sell side and efficiency, so it's labeled as BISI fair value gap. The bearish fair value gap is labeled as SIBI fair value gap or sell side imbalance by side inefficiency. So in the BISI fair value gap, it is a 3 candlestick pattern. When you have a candle number 1, like so where the upper wick and the lower wick of candle number 3 up here do not overlap, creates this gap. So if you notice, this is candle number 1, this is candle number 2, and this is candle number 3, candle number 1's wick, the high of that. And candle number 3 up here, the low of that wick, they don't touch. So between this candle wick slow and this candle wick high, they're not touching only the body of candle number 2 traded through that area. That is the ICT fair value gap. A bullish fair value gap is called a BISI rate, buy side and balance, sell side and efficiency, because it only offered buy side delivery in this fractal price action between this wick's high and with this wick's low right in here. So within the model that we're going to be teaching later in the series, what can happen is price can return back to this fair value gap. And it's an area where sometimes it will refill it in to rebalance the inefficiency, which price created once price taps the low end of a fair value gap, and then it leaves that area and expands higher. If it completely fills it in and then leaves that area and expands higher, this becomes a rebalanced area because it's inefficient in price delivery here. So once it pulls back down to low end of it, that's called a repricing. Once it touches the low end, once it breaks higher or lower in either direction and leaves that range, this becomes rebalanced, that fair value gap. Similarly, in the bearish idea, it is a 3-candlestick pattern. We have, this is candle number 1, this is candle number 2, and this is number 3. So candle number 1 is always going to be the start of the fair value gap. You look at that lower wick right there, and then the upper wick of candle number 3. So really, you're just looking to see between candle number 1's low and candle number 3's high. Their wicks, are they touching? If they're not touching, it will always create this gap or this imbalance in price. So this is called a SIBI, a sell-side imbalance by side inefficiency. It is a bearish fair value. Yep, it's just the labels that ICT gives it. So in this example, if price were to pull back into here in the model, you'll see that later in the series, this is an area within the specific model that we're to be looking at where we anticipate for price to reverse at and starts to continue lower. Similarly, in this idea of price, we're to reprice all the way back up to the fair value gap high. Once it completely fills all that in and then leaves that price area, whether that be higher or lower, once it just leaves that range, this area can become rebalanced, or it does become rebalanced because this creates an inefficient price delivery when it only offers sell-side delivery on this candle number 2. So notice how it just trades down, right? You don't see any wicks covering the area from this candle's low to this candle's high. It needs to balance that out. So eventually they usually do get rebalanced, not immediately. And especially in this model that we're going to be talking about, I don't always look for it to completely reprice back to the fair value gap high, because a lot of times when it does that and it's quick to do that, it's not really a sign to me that we're in a heavy sell program and a bearish idea. So a lot of the times if I'm looking for fast delivery and I just want to see it take off towards the buy side target, when you're in good trades, that's usually what happens. Price will just tap into the fair value gap and just leave that price area, and you'll start to see speed and velocity towards buy side or sell side liquidity. I often like to see that, which we will talk about later in the series. I don't always want to see a complete deep retrace because that's showing a lot of times, especially if the fair value gap is high up in the range. It's showing that price is in a high resistance liquidity run, which we'll also be talking about, but this is the basics of a fair value gap. So now we can dive into a real chart example. I want you guys to take a look at this chart. If you're new and you haven't been trading ICT for a while, just try and look for those signatures and price action that we just talked about, a bullish fair value up or a BISI, and then a SIBI, or a bearish fair value gap. So pause the video real quick and see if you could find any examples on your chart. So if you notice when price reversed up in here, we do have this bearish fair value gap. So this is where in my trading view, I'll just have a safe template and I'll label it as a SIBI fair value gap. I just have it in red, and you could see that this is candle number 1 up here. This is candle number 2, this large candle, and this is candle number 3. Just between this candle's wick, the lower part of candle number 1's wick, and the higher part of candle number 3 is double. See how it only candle number 2 went through that area. So this creates an imbalance in price delivery. So it only offered sell side delivery. You could see that we're chopping around in here. Notice price repriced to the fair value gap high. Like I talked about when this happens, sometimes it does indicate that high resistance liquidity run. And you could see what happened after that. It's not always the case, but sometimes where it's just constantly chopping back and forth, and then it finally leaves that price range and heads lower. This is a bearish fair value gap. Now similarly right over here, where we actually have the exact same thing where we do have this bearish fair value gap. So between this candle's low, this is candle number 1, we have candle number 2 and candle number 3. We have a bearish fair value gap. So when price is in sell side delivery, these are levels where I anticipate for the algorithm to reprice back to and then act as real resistance. Now, later in this series, you're going to be figuring out how to pick the right fair value gaps, which a lot of people don't talk about. We'll be using a specific model, and I'll show you guys kind of the 3 main functions on how I use fair value gaps. So this series is meant to be more personal, basically how I've utilized ICTS mentorships and created my own model from it. And I'm just sharing it with you guys, sharing the refinements that I've made over the last over a year now trading ICT concepts, and hopefully it improves your trading. So we have another fair value gap right in here. You'll notice that the more time you spend looking at these fair value gaps, the easier it will be. I don't want to spend too much time on this because I'm almost positive. A lot of you guys already know what this is, but this is what bearish fair value gaps look like. If we look at when price is trading higher, you'll notice that we do have a bullish fair value gap in here. This is a buy side and balanced sell side inefficiency, or a bullish fair value gap between candle number 1's high, candle number 3's low. We do have this big fair value gap. Price trades into it, rejects it, and then trades higher. So it's just kind of consolidating in here in this one, it completely wicked down. This was at 2 p.m. wick straight down, but it did. the bodies did stay within that bullish fair value gaps. That is a bullish sign price started to trade higher. These are some examples of bullish fair value gaps. We do have examples of smaller ones. It's not always going to be this big imbalance right here. Sometimes it can just be a very small one. So all the way deep in a discount down here, we have this little small bullish fair value gap. When you are on side with smart money and you already know where price is drawing towards, that's when you refer to these bullish fair value gap. So you're not just going on a chart and just trying to label every single fair value gap. And that's where a lot of ICT traders mess up. So I see a lot of ICT traders just starting out because I did the exact same thing. And the purpose of the series is for you guys to kind of lean on the experience of me trading his concepts for over a year. That is ICT. And learn from my mistakes. So what I did when I started out using ICT concepts is this is what I was doing. I was marking out a bearish fair value gap on the hourly time frame. And then on the same time frame, I was marking out a bullish fair value gap. So you're marking out bullish and bearish fair value gaps. That's not the most optimal way to use ICT concepts. And in fact, that's not what ICT is doing. He's not marking out both sides, both bullish and bearish PD arrays. Now, when price is in buy-side delivery, he can mark out bearish PD arrays for them to be used as inversions. But the primary function, when price is in a buy-side delivery program, isn't to extend over bearish PD arrays for the purpose of looking for sell setups out of them. You want to be looking for buy setups out of them. I know that does seem a little weird, but you'll be learning that later in the series as well. The main purpose of PD arrays is to mark them out. Once you already know where price is heading, then you can refer to these bullish fair value gaps, and you can hunt for those lower time frame setups out of those. So if you were to look at a lower time frame in here when you're marking out this bullish fair value gap, I'm not necessarily just buying because it's a bullish fair value gap. I'm buying because the draw on liquidity is for price to target the highs above here. So I'm to teach a model in this series where you'll be able to finally draw on the liquidity. You'll be able to know which levels to target, and that'll help you to mark out PD arrays along the way and be on the right side of the curve. So those are bullish and bearish fair value gaps, or BISI and SIBI's buy side and balanced sell side, and efficiency is the bullish fair value gap sell side and balanced buy side, and efficiency is the bearish fair value gap. Now we can move on to breakers. Have the bullish and bearish breaker in a bullish breaker. Price creates a low, a high, lower low, then a higher high. Once it creates the higher high and price closes above this previous high right in here, you're hunting for an up-close candle or consecutive up-close candles in the price lag that creates the high. In the bearish example, we have a high-low, higher high, lower low. You're looking for a down-close candle or consecutive down-close candles in the price lag that makes the low. When price closes over the high, that is kind of like the basic entry pattern for a breaker, is it kind of validates it when it closes over the high in the bullish example. When price returns back to the breaker, that would be the long entry. We'll also go over some potential stop placements later in the series. This isn't the main model that I used to trade, but I can use it as confluence and also for targets. But it's important to understand this PDR just because there are certain scenarios where I do refer to it. So in this example, when price creates a lower low and closes beneath this low, or the down close candle or consecutive down close candles in that low, when price returns back into the down close candle in here, this would be the short entry in the breaker. So this is what bullish embarrassed breakers look like. There's not too much to add here in the bullish example. We're looking for an up close candle or consecutive up close candles in the price like that makes the high. In the bearish breaker, we're looking for a down close candle or consecutive down close candles, and the price like that makes a low. So now let's take a look at a real chart example. And I want you to pause the video and try to identify a breaker. I haven't even looked at this chart beforehand. I just glanced at it because I want to show you guys what goes through my mind when identifying breakers, because it's just second nature to me. And that's because I've spent a ton of time back testing it. And that's the way you're going to get the most familiar with these concepts, is by spending a lot of time looking at it and studying it and journaling it. That's the most important part. So just take a second, pause the video, and just try to identify a bullish or a bearish breaker. I'm to mark out both. So if you look over here, we do have a bullish breaker. And the reason that this is a bullish breaker is because we have the exact signature that we just talked about. So I'm going to go ahead and I'm going to copy and paste this over. And you'll notice that we have this exact sequence going on. So price creates a low, a high, a lower low than a higher high. So you could see over here, low, high, lower low, higher, high, low, low, high, lower low, higher, high. So what we could do is in this price like that creates the high, we're looking for an up close candle or consecutive up close candles. See how there is two in a row. So we have this candle and this candle. Since there is two in a row, I'm going to mark out both of them and extend them over. So this is my bullish breaker. Why aren't you just using the last up close candle because there's two in a row? If this up close candle right here was a down close candle, I'd just be using the last up close one since it's two in a row. I'm using both. Now the last up close candle is the sweet spot within that breaker, but this is the entire breaker because there's two up close candles. So again, low, high, lower, low, higher, high price breaks above that. What about in here? When it's just consolidating in here, this is just time distortion. So this does not validate nor invalidate the breaker by price chopping around in here. My main concern is that price broke above it and then closed above it. Now, what if it fails to make the higher high and then it just continues lower? That's not a bullish breaker then, right? It would have to close above it. There are ways to pick out a bottom in here, right? If you really know what you're doing, there's ways to pick out a bottom in here and anticipate for breaker to form. We'll be talking about that in the series as well. So when price breaks higher and closes above it, when price retests it, if the draw liquidity is higher, this is an area where the algo will refer back to what you does right here. Just taps into it. Notice I'll just taps in the breaker, then expands higher away from it. This is an area to hunt for lower time frame setups in here, but that's the basics of a bullish breaker. And here, if we go down into a lower time frame, right? I'm just randomly seeing this. We have the same exact idea. So we have a low, high, lower, low, higher, high. So what I can do looking this price, like from low to high, is there an up close candle or consecutive up close candles? See how there's three? Well, I'm to mark out all three of them. Price closed above it right in here, price consolidated in it. And this is an area where the market can refer back to before seeing higher prices if the draw on the liquidity is higher. So you see all these YouTubers talking about this is the bullish breaker. As soon as it forms this buy, as soon as it forms this sell. No. If you're just looking for the pattern, it's going to be useless because I can look in here and I could spot bullish and bearish breakers. I can make the case for both sides of the market. This is a bearish breaker in here, so I'm not just going to cherry pick ideas. This is a bearish breaker and it failed. So now we need to know, okay, why did that fail? That shouldn't have failed, right? Well, it should have. And the reason is because the draw on liquidity was higher. So this is an example of a bearish breaker where we have a high, low, higher, high, lower, low. Once it creates the lower low closes beneath it, this previous lower right here. So once this low closes beneath this one, we have a valid bearish breaker. So we look for a down close candle or consecutive down close candles in the price like that made the low. So again, high, low, higher, high, lower, low. See how there's only one down close candle? I would only use one. So price returns back to it, but then it cuts right through it. Why doesn't that act as resistance? Because the draw on liquidity is for price to head up to the buy stops up here, okay? If the draw on liquidity is higher, you do not want to hunt for bearish signatures and price action, whether that be a bearish fair value gap or a bearish breaker. If we zoom in here, we can go down into a 30-minute time frame, right? You can spot these anywhere. I'm actually going to go down into a 15-minute for this example. So notice we do have a low high, lower low, then a higher high. So this we're looking for an up close candle or consecutive up close candles in the price lag that made the high. See how there's just one up close candle and this is the highest one. So look for the highest up close candles or consecutive rate or up close candle or consecutive. So in here, there's only one that's the highest. Why not incorporate this one? Well, because this one went higher. So if I delete this, you'll probably see what I'm saying. I'm not going to mark out these two right here because this one up close candle went the highest. So this is going to be my bullish breaker. So I'm going to mark that out. I'm not going to be looking for bearish breakers because the draw on liquidity is higher, which again, we'll be talking about later. Now, when price was bearish, how can we identify some bearish breakers in here? So over here, notice we have the high, low, higher, high, lower, low. In this price lag that creates the low, you're looking for a down close candle or consecutive down close candles. That's going to be the bearish breaker. So we have that right here. Price returned to it and then expanded lower. Why am I not using this lower wick right in here? Well, because it's just the two down close candles. From my experience of trading ICT concepts, I've only seen them mark out the two down close candles, and he won't incorporate that lower wick, whether that's significant or not. Whether the meaning, whether the wick is large or not, he's still just marking out the two down close candles. From my experience, that's what I've seen, but the reason I'm selecting these is because we have a high that formed right here. We have a low, higher high and a lower low. So once it closes beneath it here and price returns back to the breaker, that's going to be an area if the drawn liquidity is lower for price to expand off of and trade lower. You can see that we have a bearish fair value gap in here. The algorithm's referring to those bearish PD arrays as it's targeting these levels of sell-side liquidity right over here. So that's an example of a bullish and bearish break. We do have another one over here. So price creates a high, low, higher high, lower low. So in this price lag from This high to this low looking for a down close candle or series of down close candles, we have that right there. Price rejects that and then expands much lower for the sell side of liquidity. So that's going to be it for breakers. Let's move on to bullish and bearish order blocks. You can see that we do have a bullish order block here. Similarly in the order blocks, just as it was for breakers, we have a down close candle here. If there is a series of down close candles, you'd mark out the series. I'm going to be diving into that in a second, so just stay tuned. A bullish order block is when price creates a down close candle or series of down close candles and price breaks over them, creating a bullish fair value gap. So once it creates the bullish fair value gap and the 2022 ICT mentorship, that's what makes it a high probability order block. Just because it has the title, a high probability order block doesn't mean every time it forms, it's a high probability trade. You need to understand where price is going and you need to understand where to look for the setups. We're going to cover that in the series. So right here, price breaks over this bullish order block and it creates a bullish fair value gap. So again, from this candle's high to this candle's low creates this imbalance in here. Once price does that and it closes over the order block, creates the imbalance, comes a bullish order block. High probability bullish order blocks are when price takes out liquidity, makes a market structure shift which does right above this candle's high right in here and also forms an order block or forms a fair value gap. Similarly in the bearish idea, you could see that price has an up close candle right here, breaks lower, creating a bearish fair value gap. Okay. Also a market structure shift by breaking beneath this previous low right in here, so it would have created a market structure shift there. And high probability order blocks will also run out liquidity. So this is what a bullish and bearish order block looks like. The down close candle is the bullish order block in this example. The opening price of that down close candle is the sensitive point, that order block. So price typically will return back to that open and then expand away from it. Price can also return back to the 50% point. So when you draw a Fibonacci from the swing high to the swing low, I'm not using Fibonacci ratios, I'm just figuring out the midpoint of this down close candle. Price could return back to there. If you're bullish, you don't want to see it close beneath 50%. If it were to close beneath 50% or mean threshold, that's what ICT calls it, MT, mean threshold. If it were to close beneath 50%, it's more likely that you have the wrong draw on liquidity and price continues lower. Doesn't mean always, but there is a high probability chance that if price closes beneath the 50%, that it's likely just going to continue towards the lows down there. The same exact logic applies for the bearish idea. The up close candle is the order block. The opening price of that up close candle is going to be the sensitive point of the order block. You could also draw out mean threshold, which is 50% of the order block price could return up to there. If you're bearish, you don't always want to see it return back to 50%. And if it were to close above it, then it's likely to just head for the high. So you don't really want to see something like this. If we're to close above it, it's likely to just run out the buy side higher. When price returns to the opening price of the order block, this is a sensitive point and that's likely where price will reject, or in that vicinity before price continues lower. If the draw on the quantity is lower, this is a bullish and bearish order block. If we take a look at a chart, you can go ahead and mark out the order blocks that you see, and then I will mark them out on my chart. So I'm to mark out some bullish and bearish order blocks in a second. So if you look over here, this is a bullish order block. We have a down close candle followed by price heading higher, creating a bullish fair value gap. So this entire down close candle right in here is a bullish order block. So if you mark out the opening price of that order block, that's generally a sensitive point. You could see that price taps it perfectly right there and then expands away from it. So since the draw on liquidity was lower, it only takes out this little small short-term high in here before dropping lower. But this is an example of a bullish order block. If we look up here, here's an example of a bearish order block. So notice how there is two up close candles in a row. I'm not going to mark out the upper up close candle. I'm going to mark out the opening price of the consecutive up close candles. So notice we have an up close candle here and up close candle here. So we have two in a row when price breaks lower and creates this bearish fair value gap that validates this as a bearish order block. These two consecutive up close candles, when price returns back to the opening price of the consecutive, that's going to be a sensitive point for the algorithm to refer back to and then expand away from if the draw on the quality is lower. So it taps it and then drops lower right in here. We do have another order block. So see how there's just one up close candle and then it dropped lower, creating a bearish fair value gap right here. This makes this a order blocks, since it created a fair value gap after breaking through that up close candle. So when price returns back to that opening price, this is going to be a sensitive point and then price will likely drop lower. This is technically a propulsion block because it's an order block that retests an order block, but it's still an order block. So we're just going to be referring to it as that. When price creates another 2 up close candles in here, it drops lower, creating a bearish fair value gap. When price returns to these consecutive up close candles, the entire thing is the bearish order block. Both of these up close candles is a bearish order block, but the opening price of these up close candles is going to be a sensitive point of the order block. So bearish institutional order flow is just when up close candles are being respected, just like we have here. Price drops lower again, returns back up. Where does the algorithm refer back to? It refers back to this up close candle. So again, we have another up close candle in here. Okay. Followed by a fair value. Yeah, so once we have that, it makes it a valid order block. Notice in this example, it doesn't reach up into that opening price. Remember, the entire up close candle is the order block here. It still does tap it. It just means it's extremely weak because it's not willing to return back up to there. It just wants to tap into that lower wick and then expand lower. So in instances like this, where you do see a large lower wick, what you can do is you can mark out both the lower wick and the opening price, okay? Price will refer back to that lower wick. If it's pretty big, you could also mark out the mean threshold. You don't need to mark out all these things. Typically, I'll just note on my chart where the order blocks are, where the fair value gaps are, and I don't leave them on my chart. So in this example, notice it taps into the lower wick to that open around that area. Then it starts to expand much lower for the sell side of liquidity lower. So those were some examples of bearish order blocks in here. We do have an example of a bullish order block. So really, I'm just looking for a down close candle or series of down close candles followed by a gap or a fair value gap. In this example, we do have 4 down close candles in a row. So I'll mark out the opening price of the 4 consecutive down close candles. And I'm going to extend that out in time, meaning I'm going to drag that out. Notice how I created these down close candles, followed by this fair value gap right in here that makes this a valid bullish order block. I'm going to utilize how in the model, we're mainly using these order blocks to find drawn liquidity targets. That is free later lesson though. So again, we're utilizing the opening price of the consecutive down close candles. We have 4 in a row. I'm not going to be marking out this one price breaks higher closes above the order block, creates a fair value gap, returns back to the opening price of the order block. That's a sensitive point, and expands away from that. So that's a sensitive point. So in price trades higher here, bounces off that order block. The draw liquidity is for price to take out this high. When price returns back lower in here, we do have a small little order block in here. So it's not always going to be a down or a series of down close candles. Sometimes it's just one. Why is it just one? Because there's only one down close candle here. If there was 2, I'd mark out the opening price of 2. In here, we do have a down close candle followed by this small little fair value gap right here. So sometimes it's not super easy to see, super important to go back and back test, really study these. Have to back test in order to train your eye to see it. Repetition makes mastery with these concepts or with anything. So since we have that fair value gap price breaks above it, I can mark out the opening price. Notice how price is sensitive to that opening price of the order block. We can mark out mean threshold, which is where price really came down to a dug lower, but it didn't take out the love, the order block. If price were to take out the low of it, then it kind of invalidated that idea of this being a bullish order block. So we'll go over stop placement and later lessons. Price returns back lower. ICT talks about wicks do the damage, bodies tell the story. So wicks, they did damage here. They took out some of the stops, but it didn't take out that low. The order block wicks do the damage. Bodies tell the story. How do the bodies tell the story? Well, it's showing that bodies are not willing to go beneath this opening price and beneath this fair value gap. And it did that twice. So this is a sign to me that likely the algorithm has not left the buy program and it's going to continue to seek buy stops. So where are buy stops at above this high and then above this high as well, and also above this high? So that's going to move us on to the last part of this lesson, which is sell side liquidity and buy side liquidity, or sell stops and buy stops. Sell side liquidity is below old lows. Buy side liquidity is above old highs. So smart money likes to target these old lows and engineer these old lows. So retail traders put their stop losses beneath them. Then they like to target it before taking price to a level where they can exit that long position that they got it. And you might say, well, damn, what's the purpose of this? Why there's no way there's this huge thing going on behind the scenes where they're just engineering these old lows, targeting them? Well, the purpose of this is smart money trades with a whole lot more money than we do. They're trading with billions of dollars. And in order for smart money to get in order for any of us to get in, there needs to be a counterparty to our transaction. So for every buyer, there must be a seller. For every seller, there must be a buyer. Let's say, for example, we're just going to use extremely basic numbers right here. Let's say that smart money wants to buy $10 worth of the S&P 500 right here. This is just for example purposes. So they want to buy $10 worth of the S&P, but let's say retail collectively is only willing to sell $5 at that level. Well, they need to do something on the chart which is going to entice retail to sell more. Okay. So when price starts to take out these old lows in here, well, breakout traders, well, now they could start to sell more, right? And now any retail traders, so let's say they were trying to buy the $10 worth of the S&P 500 in here, but retail was only willing to sell $5. Well, from what they have taught us in the books, right? When price breaks beneath an old low right in here, there's breakout traders. So when price breaks an old low, retail is looking to go short and target lower levels. When price also breaks through an old low, any retail traders that were looking to long this potential retracement in here and then target the high, their stop loss beneath this old low is categorized as a sell stop or sell side liquidity. So when price takes that out, their sell order becomes a sell market order when price takes out this low right here. So there's sellers getting pushed into the market when price takes out this old low by the breakout traders and by the sell stops. So that may add more liquidity for the counterparty of smart money transactions. So if they can only get $5 collectively of retail selling up here, when price takes out this old low down here, it's engineering more sellers into the marketplace. So that's what the algorithm is coded to do every single day. It's coded to create old lows, then run them if the bias is bullish and then expand higher because it's inducing retail short and it's taking out retail sell stops. So there's going to be sellers always all the time below old lows that give smart money more liquidity and a counterparty to their transaction, right? So price is going to take out those old lows. If the bias is bullish, then target buy side liquidity above old highs. So it's always moving from sell stops to buy stops or buy stops to sell stops. In a bullish example right over here above old highs, we have buy side liquidity. So if the bias is bullish, right, price will take out old lows, which is sell side, the liquidity, and it'll target buy side liquidity. So when you're anticipating for higher prices, price is only going beneath old lows for smart money to buy from sellers and then target higher prices. So smart money buys at a discount down here. They also need to target old highs. Why? Because there's buyers above old highs, there's buy stops. So anyone that trades breakout stuff taught in retail books, they're buying above an old high. Well, that is a buy order for smart money to sell to. Also, any retail trader that goes short in here when price retraces back up, we're all taught in books to have our stops above old highs. So there's going to be buyers in those two aspects above this old high. Smart money leaves behind old highs to then target later on to have exit liquidity. So essentially the market is always going to target old lows and it's always going to target old highs. So that's the basics of buy side and sell side liquidity, and that's how it is used for smart money to have a counterparty to their transaction. And they really do engineer these old lows to create liquidity. They use the retail patterns that they brainwashed everyone with to create a counterparty to their transaction. And they're doing this every single day. So if we're going to look at a chart in here, here's an example of buy-side liquidity. You're really just finding an old high. If you want to find more significant liquidity, look at a high where price created a high. It moved away from that high for a little while and then it returned back to it. Okay, that's going to be more significant because it allowed time for retail traders to accumulate short positions and put stops above the high. And then also when price breaks above this high, breakout traders are also buying. They have people to sell to, they have buyers to sell to above the highs. Price takes out that old high and then targets the sell side of liquidity down here, because there's going to be sellers beneath this old low. Small money can buy back from them if they want to, or they can target lower liquidity below old lows is sell side of the liquidity. So each of these old lows in here, this can be a target when the drawn liquidity is lower. The algorithm is going to target old lows because there's sellers beneath there. If they want to buy back their short position, they need someone to sell it to them. When price takes out these old lows, breakout traders are shorting. Also people that got long in here, lots of stops are going to rest beneath these old lows. So they really manipulate retail traders with the logic that they were taught in books and that we're taught in books. I'm a retail trader as well and use it against them. And I know it's hard to believe, but when you see the execution videos that ICT does, and then I post, and you see how these concepts can actually work real time, Your eyes will be open to the manipulation that occurs in these markets every single day. That's going to be it for this lesson. Hopefully you guys enjoyed and stay tuned for episode 2 tomorrow. Catch you later.